Got Amnish Aggarwal who's joining in. Amnish, hi there, morning. Let's get in a sense as to how you're reading into this kind of movement that we've witnessed, the whole IT banking space, and what is your key takeaway?
You see, the main thing is that there's a typical sectoral rotation which is at play. For example, banking was one of the best performing stocks last year, segment last year. But if you look currently, there is no incremental trigger which is left in banking. For example, we might have seen already the best of the names, or maybe in another quarter or so, the names will, you can say, more or less peak out. And there are some early concerns which are now being raised in some quarters that the next NPA cycle or some credit recovery issues might come, on the credit card side or the personal loans. So I think the banks are reflecting some sort of a fatigue at this point of time, because whatever good was to come in terms of numbers, whether you look at growth, whether you look at, you can say, NPAs, credit growth, profit growth, it has come last year. This year is going to be maximum, I think, 8 to 10% growth as far as the bank Nifty is concerned. And I think one needs to look at, say, next few quarters. I think it will be consolidation for banking index for some time to come. Now, contrary to IT, I would say that post, say, last year, in the last year and a half, we have seen actually IT index, you can say, the P multiples have corrected, earnings have been cut, but more or less you can figure out that whatever negative was to happen, so all the negatives are there. So it has been more like a contra buy for us also from the last, say, couple of quarters. And I believe that as we go along, and if the kind of negativity market is factoring in, whether it is US markets or other exports, that doesn't come through, then I think we might have already found the bottom as far as your IT index and stocks are concerned.
Fair enough. Meantime, we've been seeing, Amnish, this sort of dizzying rally play out within the entire defense and railway space. Do you believe that there's more steam yet to go, given that there have been, for instance, triple-digit returns for some of these companies in the last few months itself?
You see, one of the reasons I will actually, these are two very different ball games when it comes to defense. The defense orders are usually very bulky, and if you look at, say, past year or two, the defense stocks, they were trading at, many of them at, say, high single digit kind of P multiples. Now, if you look at, say, last 4 or 5 years, there has not been any material change in earnings. But yes, given the fact that there's a lot of government focus on Make in India, the order flow has improved, there's a probability that their growth rates will increase in future. But having said that, given the focus of the government, increased order flow and the kind of multiples they have trading earlier, so there has been very sharp rally in many of these defense stocks. But having said that, the space continues to look good over the medium term, with just one risk, and that is a political risk, which is significantly attached to the defense stocks. Now, when it comes to railways, I think railways is another segment which on the capital goods side is getting a lot of government attention. There's a lot of talk about the increase in the outlay by railways when it comes to, say, capex, modernization and all that stuff. So I think that is actually resulting in your increased orders for all the railway related companies, and the stocks are doing well. Now, I believe that both the themes are potent in the long term, but at the same time, they are driven by the initiatives which are taken by the government and not purely by the private sector. So as long as the government is, you can say, attuned to investing more in these sectors, initiating more Make in India, developing the railways, and till the time the order inflows will continue to be strong, and the markets will continue to remain excited about these companies.
Why is mid-cap IT doing well? Is it only that they are niche and they're specific? Because whether it's Persistent or LT Mindtree, there is a strong outperformance within the mid-cap IT space now.
You see, some of these companies are not strictly mid-cap in that sense. For example, LTI Mindtree has quite scaled up now. But having said that, if you look at, say, the entire piece over here, I think the growth rate of many of these mid-cap companies has been superior than the large-cap companies. So that is one. The second is that markets always love growth. If you look at, say, past 3 to 6 months, and IT services is not different. The mid-caps and small caps, they have significantly outperformed the large caps. So the market today is running after growth. The market is chasing the growth, and wherever whatever the growth is, irrespective of the fact that whether it is a mid cap or a small cap, market is ready to pay them even premium to large caps. So I think that is typical of, I would say, a very broad-based rally which is playing out, and IT is not very different over here.
Amnish, what's the take on auto? And I say that because, you know, today you'll have all the monthly sales data come in. We can already see the print coming in from Escorts. Total sales at 5,593 units. And then, of course, yesterday, Maruti made it to that 10,000 rupee per share mark, a lifetime high for itself.
You see, auto as of now is doing well. In fact, in the last quarter also, I think two-wheelers was a segment which was slightly under pressure. And even the PVs were, I would say, they posted average performance. But I think tractors last month was also reasonably good, and so were the passenger vehicles. So I think the same trend is likely to continue, at least in the, I would say, near to medium term. In the next few months, particularly this festival season is going to be crucial. But definitely, I think as of now, your particularly PVs, they seem to be on the strong wicket. And your CVs, they are holding on to the gains. This year, we might not show, say, more than 4, 5% or 6% growth on an aggregate. But having said that, the segment as of now is holding on quite well.
Well, Escorts has just been one of those phenomenal wealth creators. It's up, hold your breath sometimes. You know, we always think it's Titan and HDFC Bank and Bajaj Finance which have created wealth in the last 10 years. Escorts was a 3-digit stock, and a 3-digit stock has become a 4-digit stock. In this year, it's up another 47%. I don't know what is, I mean, this tractor cycle is doing okay, but for a stock to give a return of 40x in last 10 years, I mean, that's breathtaking by any yardstick. And one more stock which falls in this kind of a bracket is actually Tube Investments. We don't talk about it, but that's one stock which has again given breathtaking returns in last 10 years. Last 10 years, Tube Investments, 127 has become 3,000. Wow. Amnish, Escorts existed, I mean, it went public in 1990s, but the gains have come in last 10 years. And similarly for Tube Investments, I mean, it's an old company owned by one of the oldest corporate group in South India, but last 10 years, the stock has taken a giant leap forward. Why is that? I mean, what has happened in Tube Investments, Escorts, which is so transformatory?
You see, Nikunj, in fact, Escorts, I think it didn't get listed 20, 30 years back. I think it was one of the companies which was rated by Savraj Paul way back in, I think, late 70s or early 80s for a takeover. So it's, I think, it has been listed from donkey's years. What has happened over the years is that, you see, Escorts had been an underperformer. It was present in practically every segment, ranging from, say, a two-wheeler to, for example, it was there in telecom and all. And over a period of time, they continued selling businesses one after the other. Now, what they left in the end was some sort of, you can say, mainly the tractors as well as some railways and construction equipment business. Now, what has happened in Escorts, particularly in the last few years, is that Escorts is now a subsidiary of Kubota, which is you can say, a big Japanese MNC. So the management focus has come in, and there is more now interest in this company because Kubota is likely to make Escorts as a sourcing hub for their global operations, and so the growth of this company might not be totally dependent upon the growth of the Indian tractor market. So that has been an instrumental factor in re-rating of Escorts, say, in the past few years.
Thanks very much, Amnish, for joining in and sharing with us your outlook on the markets. Let's find out what the